In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Good morning, good afternoon, and good evening, wherever you are in the world listening to this is the Fundability podcast. I have two amazing guests from one amazing organization, and can't wait for us to do a deep dive, because in the world of fundability, our first play, the bullseye, right? The arrow splitting the arrow bullseye is stated income and unsecured business lines of credit. But what happens on that outer ring, right? When we start moving a little further out, sometimes we don't want just $100,000. What happens if we have amazing tax returns? What happens if we have where we can go beyond stated and do full doc? Well, my guests today are Byron McBroom and Melanie Sikma, and they are the dynamic duo at One Stop Tax Strategies. And this organization specializes in prepping borrowers to hit that 250 mark at lenders across. And remember, while there may be a half a dozen solid borrowers or half a dozen stated income banks that go to that 100K, no problems, write a check and do a deal, there are dozens that do full doc with even better rates and terms. So if we can get to that next outer ring, and that's why I brought my guests on to speak with us today. Welcome, Byron. Welcome, Melanie. You guys, welcome, Melanie. Welcome, Byron. I love that we're going to be talking about this, because as the economy contracts, lenders are still lending to bullseye borrowers, but now sometimes they need a little more documentation. So please introduce yourselves and tell my crew who you are and what it is that you guys do for sophisticated real estate investors.
All right. We are a father-daughter duo. My sister's in the business as well. And we help entrepreneurs and business and real estate investors pay less tax so they can focus on growing their portfolio and, focus on the more important things in life, like building their dreams and enjoying those things. So,
nah, come on. That stuff's overrated. We're here because we're workhorses, right?
There you go. That's awesome.
All right, Byron.
Well, this started years and years ago, because I've been a CPA since probably most of you have been business owners.
Longer than I've been alive, we'll say.
but I noticed that a lot of CPAs were out there and were just filling out the forms for people. So I've always been one that liked to be creative and take more of an approach to it. So I kind of backed away a little bit from my firm and just started putting together packages and ideas and kind of systemized a lot of the ideas. So we've basically developed a process for people to have a significant reduction in their taxes. And we just get a kick out of helping people and giving them a lot more money to help achieve their dreams.
Mm-hmm.
Excellent. So to bring my tribe up to speed, guys, remember that one of the things that you have learned when you came to the Get Fundable tribe was the fact that lenders, especially our lenders, are looking for top line revenue, but they want to make sure that the bottom line on your tax return can cover their $100,000 credit line cost, right? Which is about $870 in interest only. So our numbers, just so to key you guys in, our numbers are always, where's that? How many multiples of 870 is my tax? Is my taxable income? So that a lender can literally like, okay, I'll carve out that piece right there. Yes, I'll approve you. So top line is critical for us. But bottom line is how you guys can save my people money. So what is it that you guys, give an example of how you've helped real estate investors?
Well, we have one client in particular that we like to use as a guinea pig, kind of a star student case study. He came to us and he was netting $1 million, right, Dad?
Well, but it was really more than that, but
Yeah. And
You
so
use
what
a
we
million.
We'll round down for
round down, there you go. So he was looking at, and he was in California, so he was looking at paying almost half of that to taxes. So you work your butt off to get to that level, and then just throwing it half away to, we know the government's using it super well, but
I know they're the best. They're the best charity to give to, right? Because
exactly.
there's no operational costs.
Yeah, yeah. So he was just kind of like, that's you're defeated at that point. And so what we did a few strategies, one being getting his kids on the payroll, one, renting his house to his business. That's a strategy. Another, we looked at the people around him that he was helping, like his in-laws. He had a daughter going to Arizona State. So we did our strategy where we shift some income to their lower brackets. And we're able to reduce his taxes by almost $70,000 each and every year. We also were able to do a deferral strategy, which reduced his income really as low as we wanted it to go. We were able to get it down. And he used that money to fund his real estate. And that was back in 2010. And so now you can imagine his portfolio, we got up to a $15 million deferral. He used that to fund his real estate. And now it's, I think, over $24 million worth that he's used.
Yeah.
Okay,
Yeah.
now cash on cash, a $15 million deferral savings into a $24 million empire. We're talking a 60, 70% ROI, right? Cash
Well,
on
he's
cash.
even winded that down. Now he only owes, I think, 2 million and it's worth 24. And it's money he would have given to the IRS. So it's pretty
the
cool.
way that works is he had a $15 million tax deduction that we took over several years. And so he actually saved, he owed the IRS still. He still owes it, but he just has the use of that money. He really had $7.5 million of cash to work with as a result of that.
Brilliant.
And then he took that $7.5 million, bought a bunch of real estate, fixed it up, kept it, built a building, did a lot of stuff. I basically went through and we did a personal financial statement for him. And the guy had, I think it was like 19 or $20 million of mostly paid for real estate as a result. So, I mean, the guy's a heck of a businessman too,
but we are not everything, right? That's one thing that I learned. I learned that I'm an amazing mad scientist and I suck as a financial planner, right? So I have to have subject matter experts, and guys, that's why I brought this team here, is because we're all building teams. I'm not the only one who preaches this, but we need a team of subject matter experts to build the opportunity to deliver our best case, our zone of genius, and let others be in their zone of genius. So what is it that is, I was just thinking of, it kind of, I connected the dots, just like there is compound. When I was listening to your guys' story, there's compound interest, right? But aren't you guys kind of talking about compound depreciation, where if you're deferring a tax and depreciating, you're literally compounding the effect of depreciation over time?
well, I think it's even more than that, because you take,
and multiply it by 1,000.
Yeah.
for instance, we'll call him Juan, the guy we just talked about. He was able to reduce his taxes by $7.5 million. Now, the year we met him, he made $1 million, but he actually got up to $4 or $5 million a year in net income. And so he was able to reduce his taxes by $7.5 million, of which really was a 0% loan from the government.
Yeah.
And he was really using all the government's money. So what's compound interest on a zero cost? It's infinity, really.
Yeah, right. Now we're talking back. Now we're to infinite ROI, right?
Yeah.
Okay. So how do real estate investors take to capitalize on depreciation and cost segregation? Now we're using language that I think I know the definition of the word, but not the sentence makes no sense to me, right?
How do you maximize it? Is that your question?
Yes, exactly.
Yeah. Well, I mean, Dad, I'll let you take that one away because it's a little more.
Well, obviously, with maximizing that, you have to buy a lot of properties. So the more properties you get, the more you get.
Well, if the people who are listening to you are in the multiples per quarter, per month. So there's a lot of traffic going on.
And I would assume that all of these people are considered professional real estate investors.
Yes. We only have a few hobbyists.
Okay. So now to maximize it, you really just want to go through it obviously is just make sure you put yourself in a spot where you're taking the deductions. A lot of times people will take a cost seg study, take a big deduction, and it might drive them down into a 10% bracket. Well, you're better off not to do that. You might be better off to, a lot of times you can only take losses to the extent you have basis in something. I might be getting a little technical on this, but you might do things to limit your basis in that so that the losses carry forward to the next year, because you're better off to save money. You don't want to save money at 10% and have to pay it back at 37%.
Got it.
So you'd be better off. Like we looked at one guy's returns, pretty successful guy, and he had taken all the bonus depreciations to put him down at about $500,000 negative AGI. So he was really throwing a lot of money away by taking that bonus depreciation. I mean, he had net operating loss carry forwards, but he would have saved a lot more money by feathering it in just to be a little more intentional on that. That way you always save the money at the 32% or 37 or California 49%. But instead of taking it down 1 year to be below zero, and then losing a lot of deductions like itemized deductions and everything like that, you lose all that. You're better off to feather it in and be intentional over a multi-year plan.
Well, and then if you also, can I add to that? So if you add to that with like our permanent strategies that we can break down a little bit, and then if you do even the kick the can plan that we just talked about with Juan, if you do that, then you can utilize that until, let's say, if you want to stop doing real estate at some point and retire, then you still have use of the depreciation. If you still have the properties, you could still feather that out over the long period of time rather than taking it all in the first year. Now you have to keep doing it over and over.
That was funny. I just have to say, so when I met Melanie team, we're sitting at lunch at kind of a mastermind for speakers, and because we're both fronts persons, and she mentioned this kick the can strategy, and I go, have you ever played kick the can? I mean, do you know what kick the can actually means? Because I played kick the can when some of you played kick the can, and so we had a good laugh about the kick the can strategy. And I get it since I played the game, right? So tell us about the kick the can strategy, because now I just keep laughing about that conversation, Melanie.
So if you have, let's say, just to keep it simple, you have one company, and let's say it's a S corporation with a December year end. And let's say you have any type of marketing expenses, payroll expenses, or let's say, construction expenses, whatever. We could look at your P&L and figure out what makes the most sense. But if you put, let's say, payroll into a new company with a November year end, and you can mark up those services, let's say 40%, then that payroll company can invoice your main company all year long. But the main company doesn't get around to paying the bill until December hits. And so since there's that gap in the year ends, it creates a huge deduction to the main company, but it's not taxed to the support company until the following year. And so you defer it to the next year, and then you just do it again and again and again. So you basically can kick the can indefinitely, or, we say if you pair it with life insurance, you can kick the can until you kick the bucket. Or you can stop doing it whenever you want.
I was waiting for something. I didn't see it coming, but I was waiting for something.
There you go.
Play kick the can this way. And here's what's fascinating is how many real estate investors do we know? How many of you guys out there literally open up a new LLC for different properties over time, and kick the can requires a new entity and you guys would have to define whether one serves or not. But I work with people whose empires include 17 to 40 LLCs that you could play this game with, correct?
Definitely. Now
brilliant. I love it.
Just to give you an example, someone with $1 million of payroll or $1 million of, if let's say you're buying flippers and stuff like that, you could put your construction company into a November year end, but $1 million of expense, either in payroll or some other form of expense, will give you a $2.8 million tax deduction with no cash.
Little cash.
With little cash,
Right, you gotta have a little.
Okay. All right. So what's your calendar? What's your calendar link? I'm just going to set up a calendar link again with you guys before we
throw that in there
in the show. So what are some of the things? I have people who invest in multiple states, right? And they literally will follow the economy. They went to Detroit right? In the downturn. Then they went to Indiana. Then they went to Texas. And while there was this reconstruction and these rebuilds, they're moving from appreciating area to appreciating area. So what are some of the tax strategies for multi-state empires?
Well, go ahead, Dad.
I say the strategies really be a lot of the same. Now, one thing you have to be careful of when you're in multi-state empires is you might have income in one state and the loss in another state. Now, they offset each other on the federal, but you really want to have to do a little bit more planning to watch out for that, because you could be selling a property in Indiana and then buying a property in Florida. They offset for federal purposes with the bonus depreciation, everything like that, but it does create a bit of a problem statewide. So you just have to look at that individually and come up with a solution. And it really means running your numbers in November and October to make sure you have all the checks written by December 31st.
Got it. So what you're saying is do you know any like places that would be like a one-stop shop to be able to solve these kind of multi-state?
I don't know.
If you know anybody, please just tell us, we'll put it in the show notes.
I have to tell you a little bit of a funny story. We used to call our kick the can plan the crack cocaine tax plan.
Oh, okay. I love this interview so much. I love this interview so much. Tell me about crack cocaine and tax planning.
Because it was fun and addictive, but at some point in time you have to go into rehab. Okay. Because when you go into rehab, you have to pay. It's a deferral plan. So we're reminding them that at some point in time you got to pay this back. This is an interest-free loan for the government.
You guys call it feathering, but is there a way to evaporate over time to pay over time that owed amount that you keep pushing down? I love it. It's crack cocaine plan. I'm going to refer to it forever as my crack cocaine plan. I don't care about
I've had people call me, go, I don't know what I'm supposed to call you for. It's something about crack cocaine.
I know. It's like, and you know, and you're with the NSA, like, NSA, that is a code word for tax planning. NSA, anybody who's listening, that means tax planning.
Well, to absorb it, we have our hangover pills that are your cure to the pain of capital gains.
I love you guys. You are my kind of jam. Okay. So I love that you guys, because for so many people, accounting and tax planning is so dry. Are you guys getting this? We're talking about crack, and cocaine, and hangover pills, all solutions, and no wonder you're one stop. Great name.
Yeah, great name. We also have our baby mama. Go ahead, Dad. Go ahead. Oh, okay. I was going to say we also have Melanie? Our baby mama plan. Which is if you are, let's say, we look at the lower tax brackets around you. So if you are with somebody or you have a kid with somebody and you're not married, then you can basically utilize their lower tax bracket. So shift some money. Like my dad, for example, this isn't the baby mama plan. This is the parent plan.
This is my girlfriend.
This is the mistress plan.
There you go. No, my grandma, she's 90 years old and she is at the lowest tax bracket. My dad's at the highest. And so he opened up a separate corporation owned by her. He hires her company for services and she's just a passive owner, but he shifts $80,000 of his income to her lower tax bracket. It saves him about $40,000. She pays 10 and then he has her keep a little bit and gift back the rest. So he makes a profit on helping my grandma out. So,
and grandma gets to take home a pretty penny for and be the owner of a major corporation in America today.
There you go.
What was really cool about that story is, you know, my folks didn't have a lot of money and I give my mom half the savings from that. So, you know, a $1,500 check every month changes my mom.
Oh, hell yeah. That's okay. So here's the thing. I give a stipend to my parents every year, but it's literally just post-tax. I'm a dumbass. So I'm just doing post-tax, hey, mom and dad, Venmo, blah, 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 right? A couple of times a month. And when I could put them in a corporation and then are they 1099? What, we don't need to go into the details, but literally they send back half and keep more than they're actually getting right now, so we both win.
Yeah.
They get more money than I'm paying them, and I get to lower my tax benefit. You guys, are you listening to this stuff? We got baby mama plans. We got we got grandmammy. We got grandmammy plans. We got Coke addled plans, and we got what was the last one? Oh, hangover.
We could call it the Pimp Daddy plan, maybe.
The Pimp Daddy plan. There you go. The Pimp Daddy plan.
Another name for the baby mama plan. I call it the fornicator plan. So.
So see, this is me. I'm a dater. I'm a dater. So you're saying I could hire my girlfriends.
There you go. There you go.
Set up corporations.
All sorts of options.
Damn. You guys are all right.
Yes.
All right. Brilliant. Okay. So are you guys getting this? Come on. Are you seeing that not only are they creative and vastly intelligent, but they're also fun as hell? Why not work with somebody, some droll CPA? No, I'm not anything on anybody, but come on, this is amazing. All right, so you've been talking about bonus depreciation. What is bonus depreciation?
Take it away, Daddy-O.
Okay. So what they did
now he's Daddy-O. I love it. We're like, and she's drinking whiskey out of her coffee cup. Where's my? We should be. I should at least have a glass of white wine here. What the hell?
That would have been a good idea. Wine and wisdom.
Wine and wisdom. It's not Wednesday, but we could have gotten the last word out of there. I'll publish it on Wednesday. We're just going to act like it's Wednesday. All right, go ahead. Go ahead, Byron.
Well, what bonus depreciation is normally when you let's say you buy a piece of property, and let's say it's a residential property, you'd write that off over 27 and a half years, which means if you paid $275,000 for it, you're going to get about $10,000 a month. Well, what they do with bonus depreciation is you normally couple that with a cost seg study. And what a cost seg study does, it goes in and breaks the property out into 5-year property, 7-year property, 10-year property, 15-year property, 20-year property, and then 27.5-year property. And what the IRS says with bonus depreciation is anything that's in the 20-year or below, you can take it all in the year of purchase. Now, normally in a big property, for a residential thing, about 25% of the property is considered bonus depreciation. Okay. And so if you bought a $1 million property, you could take a $267,000 deduction or $270,000 deduction in the year of purchase. Now, keep in mind, this is being phased down. So it used to be 100%. Last year, it was 80%. This year, it's 60%. But they're actually having talks now about maybe extending the bonus depreciation back up to 100% as a stimulus for the economy. And nothing's passed. It's just in conversations, but I've heard that they're talking about extending that.
Interesting.
So bonus depreciation allows you to take everything up front.
Which is if in the tortoise and the hare story, I'm the hare, right? Yeah. I may never pass the finish line, but I've had a blast the entire race, right? Mm-hmm. And so I'm that guy. I'm the guy who likes, I want to write it all off today. But what you're saying is there's a way to have it all. You can go long-term depreciation. Melanie decided to go refill her whiskey bottle. Yeah. She'll be back here in just a moment. And then, but you are saying we can go for the full 27, right? I just told the audience you went to go refill your whiskey. So
yeah, I got kicked off.
Welcome back. And then you could go for 27 years on some, and you can go for 5 or 7, et cetera, and balance that out to minimize the total overall tax liability, right?
It just has to be intentional.
That's brilliant.
The key thing is to look at your particular unique situation and customize it to what works for you. And then we always like to look 2 or 3 years out in advance to make sure that we're not, doing something that's going to conflict with the greater scheme of things.
Got it. Okay. So I have a lot of my investors are, and I got some sub questions to this as well. A lot of my investors are using self-directed IRAs to invest because it can't be self-serving, right? Whatever you invest in, and et cetera. But I want to know, what are the creative ways to use that so that it passes the arm's length rules, but is also beneficial above and beyond self-directed traditional definitions, right?
Okay. Melanie, do you want to do the success story or should I?
Oh, with the yeah. You could go ahead and do it.
Okay. I have a client of mine, he does a lot of wholesaling. Okay. Now you probably have wholesalers in your group, and you also have flippers, and you have buy and holds, and you have everything. And I have another realtor who does this with big properties and keeps them a little bit. But what he does is when he's out buying, looking for properties, what he does is he ties it up with his Roth IRA. So he buys an option for a few $1,000s from his Roth IRA. Okay. And then he buys after that option's all recorded and done, he purchases the property as an individual. Okay. Then he does his thing. He fixes it up. He rehabs it. He does all this stuff. And then, so when he sells the property, the Roth IRA yanks the rug out from underneath the sale and buys the property from him as it's going into double, and does a double escrow. This way he captures most of the gain inside the Roth IRA, and it doesn't take that much cash because you're using an option.
Okay, so what my tribe knows me for saying everywhere all the time is WTF MF. What did you just say? Okay, so I go tank my own deal so that I can exercise the option because it's not self-benefiting, because I own the option but not the property, but I pull the rug out from underneath the clothes?
Oh, no, because you can't do prohibitive transactions with a Roth IRA. Okay.
Right.
But with a Roth IRA, I can buy an option to buy your property.
Right.
Okay. Now you can go ahead, and after you have that option done, I can, as an individual, I can buy that property from the person subject to the Roth IRA. And that is not a prohibited transaction, because I'm not doing business with the Roth IRA. I'm buying something subject to a loan with the Roth IRA.
This is magic. This is magic. Okay.
But that way it's not a prohibited transaction.
Right. I totally get. Okay. So I'm known in my entire industry as the dot connector, doing things that are outside the box, coloring outside the lines, but not breaking anything, right? I never, the whole truth, nothing but the truth. But there is so much flexibility when it comes to, like you said, this third party idea, another entity, and you're selling the assets in the kick the can baby mama,
An interesting fact is the tax code is so thick. If you held it out and shot a Colt 45 at it, it wouldn't penetrate the tax code.
Okay, you guys need to actually do that. That will go viral. That will go viral.
Don't hold it in front of yourself, though.
Yeah,
right. Just in case.
Hold it to the side.
Yeah.
Right. But that's my point. And so many of, you know how in marketing they say find your person and basically alienate everybody else, because if they're not your person, then why waste the time and energy, right? Well, every one of my tribe members are looking for the legal play that gives them an advantage, and you guys have given us only 42 in the 10 minutes we've been talking. And you have fun names: baby mama, grandmammy strategy. These are amazing, and I love this Roth IRA. You guys, I don't know if you know the story that one of the founders of PayPal actually put his shares into a Roth IRA, and then when it blew up, it was all tax free.
Oh man,
he takes tax free, and I went to my tax planner and I go, I want to do that.
Yeah,
I want to do that with my software, right? So tell me then, what are some of the like misconceptions or the limiting and fixed beliefs people have about tax planners, well, you've already blown everything up. My people are like, okay, I know why Meryl loves these guys. You've already blown up the misconception of the dull, boring tax planning crew, right? So what are some of the other limiting fixed beliefs that people have about tax planners or tax planning or the strategy side of things?
Yeah. I think a lot of the times people, if they have a CPA, they feel comfortable. And so we always just say, get a second opinion. It doesn't hurt. Like, it's just like any type of diagnosis, or any, if you're doing construction work, we'll say you get multiple quotes. And so why not have somebody else look at it from the outside and make sure you're good? You know, and it's the biggest expense of your life, at least one of them. And so why not have scrutiny on it? So that's one thing I'd say.
What you really want to find out is if your accountant is working for you or working for the government.
That's brilliant. That's brilliant.
Now, and then the way you do that is you have to pay attention to the questions they're asking. If they're asking questions on how to fill out the forms, they're not asking the right questions.
Okay.
If they're asking questions on how to save you money, then that's the right person for you.
Okay, got it. And so what is when it comes to, so what you're saying is, and I'm not saying anything about this conversation, but if your CPA doesn't have a little creativity, I'm not saying they have to be a cross-dresser, but if they don't have a little creativity in their bones, they might not be the right people for you, right?
Well, if you're the one always going to them with strategies, that's a red flag.
That's a huge red flag. Brilliant.
If you're making money, they should be a profit center for you, not a cost center. And so you should be, a lot of people think their busiest season is tax season, which it's busy, but our busiest season's the end of the year, because we're meeting with all of our clients, we're running numbers for them, making sure that they're marking off everything. We have a checklist of all of our strategies, and we keep continually add to it, but just to make sure that we're not missing out on anything. So I'd say that's what my thought was. That went away, came back.
Yeah. You heard it here first, guys. No, seriously, it needs to be your taxes, your tax planning needs to be a profit center, not a cost center. And you need to make sure that they're coming to you with strategies, not you're going, hey, I heard about blankety blank, right? I heard about this baby mama strategy. What do you think we should do? And they'll be like, run. Then run towards one stop, you guys. Run away from them and run towards one stop. Jesus.
It really does depend, though, on your personal comfort level. Yeah, some people want that super conservative CPA, and that's fine. Now, for that person, we're probably not the right group.
Well, then you're speaking to the right audience, because my bullseye arrow splitting of the arrow bullseye audience are people who are like me. If you're not like me, you're probably not going to fit definitely in my tribe. And you guys are exactly what I want to promote to my people, because you are creative. You do read between the lines. You open the blinds and see the truth instead of the mural that's on the blinds that we think is reality, right? You guys are actually looking for solutions to these challenges.
But I'll also add to your misconceptions too, is a lot of people, I think, especially with the IRS agents talk in the past couple of years, but they're afraid to get audited. They're afraid to, do anything that might be looked at. And the key with that is tax planning with industry averages and doing strategies with industry averages so that you can catch things that will be red flags. So our audit rate has been half of the national average. And so it just because you get creative doesn't mean you're going to cause scrutiny on yourself.
Right. No, I'm glad you brought that up, Melanie, because I totally get that there are Aristotle said that the good was the mean between the extremes, right? Evil's on both sides, and the mean is kind of in the middle. And if you guys are literally half the audit rate, then that means you are using that bell-shaped curve to your advantage, right? But not selling out because you're afraid, right? Am I understanding that correctly?
Yeah.
It's interesting what causes an audit. Most people don't know that. They think, oh, you do this, it's a red flag by itself. But what causes an audit, if you look at every corporation return, every LLC, on the top of that form, it says a code number as to what type of business that is. Okay, it might be 235110, or it might be 478653. And each code represents a different industry based on what you do. Well, what triggers an audit is when the IRS looks at your numbers and the average numbers for that code for your revenue are different. That's what triggers an audit. So you can put in there an extra rent. Like one thing we do for a lot of people is do the Augusta rule, where you use your home for your corporate board meetings. I rent my home to my corporation for $1,000 for a one-day rental, and I get $14,000 a year tax-free. Okay. But that alone doesn't cause an audit. It would only be because that's just listed as rent expense on my corporation return.
Right.
So, and almost every business has a rent expense. So that's not going to trigger, and people say, oh, that might trigger an audit. It really doesn't, because it falls within the industry averages for rental expense.
Okay. So this is fascinating because we actually rely on the SIC and NAICS codes to build fundable businesses within codes that are highly fundable. It's 8742 for the SIC and 541611. And every single one of my clients, we optimize their businesses to be those exact things because I happen to know the exact metrics for everyone for that business in every instance. So that is freaking brilliant. You guys, are you hearing this stuff? Come on. I'm a genius for knowing geniuses, not for my own account. So that is spectacular. And those red flags can accrue, right? Yellow flags, red flags, because one thing may not be out of sorts, but 5 or 6 or 10 things being out of the norm will trigger a review, right?
Well, and here's what happens with an audit is your return gets flagged and they give it to somebody to take a peek at. So what we do is we review returns to see that they're in line. If something is out of whack, what we do is we put the actual proof inside the return. Because what happens is they get the return, they give it to a person, they flip through it and they're looking at it, and you have the proof for the items that's out of whack. You have the proof attached to the return. So then they say, okay, here's the proof. They put it back in the pot. And it eliminates the audit up front. So that's another thing we like to do for people.
Are you kidding me, people? Okay. I bring on my guests because I've learned something from them, but I was not prepared for all of this. Melanie, where have you been hiding all of this, man? You didn't talk this at lunch to me while we're at the event.
Our phones were too busy.
Oh.
Now, for the people that really want to step over the line, we won't implement this for you, but we have some shower with your underpants on plans. Okay.
I love life. You guys, I love you. This is amazing. All right, tell me about the shower with your underpants plan.
You don't want that one.
We don't have any of those. That's for people that want to go to jail.
Oh, okay. Got it.
No, the do-it-yourself tax planning plan.
Yeah. Oh, the do-it-yourself tax planning. Yeah, I've been as my crew knows. I already did a stint in federal prison for ecstasy and guns, and so 22 years ago, and so that's part of why they love me is because I invented fundability optimization while I was in prison. So because I'm gonna take advantage of whatever time I got, right?
There you go.
I got a federal rebate on my taxes for the first 40 years of my life. So it was a good plan. Do not do the shower with your underpants plans, people. Okay. Do not do the shower with the underpants plans. Okay. So what is it? So tell me, like, what is upper reaches? And I want to go the higher echelons or the lower echelons of savings. Like, what if somebody came to you? I know every situation is different, but just windows.
Yeah.
What can somebody count on for cost versus benefit analysis for them to be like, well, this is easy. There's no brains required in making this decision.
Well, we always offer a free tax assessment, and that's basically I'll ask some questions, uncover estimated savings. The average person on that call That's netting over 200,000, saves 70,000.
Okay, that's at least one trip to Spain
Yeah.
for the summer.
And then and that doesn't even count that doesn't count the deferral strategy. So that's just permanent savings, and that would be year after year what we could save them. So
Got it.
that's the average. On the most that I've ever seen in permanent savings saved has been, I think, 250,000, somewhere around there. And then the biggest deferral I've ever seen is a $9 million deferral. That was the calculation that we could have spread out over times outside of our client that we talked about. That's been the other biggest one.
Brilliant. So you're saying that you guys will do a quick peek under the hood, for free, just to see if it, so somebody can say X versus Y, and know where the value lies with you guys.
Yeah, we could basically like to show them what they're leaving on the table. And then usually if we want to move forward from that, we charge a small fee for what we call our initial tax plan. And we guarantee you'll save at least 3 times it. But basically we go through and look at a couple years worth of returns. We go through and basically give you a written report on how to save the money.
Mm-hmm.
Okay. Brilliant. So what happens when you, I've got a bunch of clients who've done like EIDLs or something like that. Are there special plays in how to navigate the EIDL? Because some of them have, in the next 6 months, the next year or so, they've got these huge payments coming at them. Are there, do you know the EIDL world at all?
I don't know. I apologize.
Okay. No, that's okay. You're all beauty and brains, and then Melanie's kind of cute too. So,
just sitting here.
Right. So we'll take it. You're gorgeous, Byron. Anyway, so we have, the idea is, I'm looking for a way, and by the way, you guys, my strategy session, if it wasn't already scheduled, before the end of this episode will already be scheduled, because I had the initial, but I wanted the answers to the same questions you guys did. So I'm getting my my tax strategy planning session with these guys, because they have everybody that I've spoken with about them just raves about how hot Byron is. So we want to make sure that, and they said they just want to look at him during their session. No, actually, you have a team of people, Byron, that are all trained by you and that are all pros to make this happen?
Actually, what we do is we've developed a lot of systems, and I've trained a lot of the CPAs. We have partnerships with, I think right now is 3 CPAs, and then some of them are EAs too, enrolled agents, which is just good. But basically what my job is to design the systems, and we train the people on how to implement the systems so that everybody's getting the same thing across the board. And so we have multiple people that we can work with, and a lot of times it's just finding the right person to work with. One that matches your level of aggressiveness, one that matches your personality profile. I mean,
so I'm the tax matchmaker.
I just went there. I just went there for tax match. Okay, you look like you like brunette CPA. So I've got the perfect CPA for you. You're plus 250 net on the year. And you're a real estate investor. So we've got that. What would you say? So what would you say? You mentioned this several times about having grandmammies and children and baby mamas. Kind of get down to the essence of, you talked about lower tax brackets, but without getting into all the details, how do we defer those taxes or lower tax brackets by employing them or contracting them or otherwise? What is that mechanism?
Well, it depends. So that's the thing that all CPAs say. It depends. But if it's, let's say your kid's under 18, you can hire them through, if you have an S corp, you want to pay them through yourself as a sole proprietor, and then basically issue them a W-2 from there. That'll get you out of payroll taxes. So that's a way to hire your under 18 kids. If it's like my dad's situation with my grandma, it's through another corporation. And so he formed an S corp in my grandma's name, hires her company for services. So there's actual services being performed in that company. And
Right,
then
right.
she's just a passive owner though. So she doesn't actually have to be the one doing the work. And so that's how we funnel it that way. And so it just really depends on your particular situation. Did that answer your question?
Yes,
But
it did. Go ahead, Byron.
let me add to that. I know a lot of people probably a lot of your customers out there have kids in college, right?
Yeah,
And they would
definitely.
probably love a way to make college tax deductible.
Yes, please.
Okay, so what we do for that is similar to my mom's plan, is we form a corporation owned by the child. We basically have that child's company do a service. Maybe it's Instagram postings, social media. They do it better than we do anyway.
Right.
And then what we do is you can have, if that child makes $40,000 a year, the tax on that happens to be $2,500, and then they get a education credit, which most of us make too much money to take the education credit.
Yes.
The child gets 40,000 tax free, and you get a 40,000 deduction. And then what you do is you have the child pay for their own college out of the distributions of that S corporation.
You can also do it to get in-state tuition for some states. So like we had a client the daughter went to another Arizona state. We talked about that a little bit earlier.
Mm-hmm.
So we got her in-state tuition. So not only did we save the out-of-state tuition, now every time she comes and visits home, every time her dad visits her, it's a tax deduction because you're visiting a vendor.
Okay, so now do you have to prove paternity?
Oh, you don't have to.
Like,
as long as you trust the person.
Samples, are there DNA samples required for these children who are in college?
Not for them, no.
Well, because really, you just have to trust them to give you the money back.
Yeah.
If you're paying for their college anyway,
Well,
if you're paying for their college anyway, it's a no-brainer.
Right, but can't you also be in a joint account in which they're a passive owner and you manage
You're the signer?
accounts?
Yeah. We typically do that, but you are still shifting it to their social security, so you just have to make sure you trust that.
Oh yeah, and we want to make sure that there's zero sum, or that it's a zero sum game against their tax liability that's accounted for, etc. Of course.
Yeah.
Byron, tell me an interesting story about you so that my people can get to know you a little bit better that isn't associated with tax. I told you guys I went to prison for guns and drugs. I mean, it was ecstasy, which is now clinically legal. So I was just ahead of my time. But
there you go.
Byron, a story about you that most people don't know, but tells us about who you are and how we can count on you.
Well, I actually have a superpower. Okay. And my superpower is that I can't be killed. Okay.
He can be killed. He had a cardiac arrest once, so you can be killed.
So
he needs to be humbled.
No, that means you dodged that bullet too, Byron. I'm with you. I get it. Just because your brinksmanship is still not life-threatening.
Every time he almost dies, he almost dies again. Or every time he says he can't be killed, he almost dies again. So we won't bring on that.
We're trying not to push that envelope too heavily.
Well, I've been robbed at gunpoint.
Okay. That's a great story.
I've been stabbed.
Did you go to prison too? Where'd you serve? I was in Florence in Colorado.
I was stabbed. I was the victim. Okay. But I've also drowned. I was an abalone diver and I got tangled up in kelp 20 feet down and passed out under the water.
Dude, you're killing it here. I love this. Shut up, Melanie. I don't want to hear it.
I caused an avalanche. So I was skiing. I ducked a rope and skied out of bounds, and I caused an avalanche and had to be rescued. They had me hug a tree and they threw dynamite around me to blow the snow out. I did get arrested for that one for trespassing.
I love this.
And when I went to court, the guy said, "How do you plead?" I said, "Guilty by insanity." Right? No. 4 feet of powder, and I couldn't help myself. Okay.
And he happened to be a skier. Said, "I'm with you, bro. Let's go."
He said, "You don't have to." I said, "Well, I'm guilty of sin, Your Honor."
Yeah.
He only fined me $100 though, so that was good.
Well, because life-threatening and ears bleeding from the dynamite was enough of a punishment.
And then I had a cardiac arrest. And then
he had a heart attack.
No, I had a heart attack. I was mountain biking and I had a heart attack on top of the hill. And my friends I just thought I was having a bad stomach because I ate a bad burrito at Starbucks, But they actually left me on the top of the hill. I said, "I'm going to ride my bike down the road. You guys go down the trail. So they left me up there having a heart attack all by myself. Thank God there was a doctor who rode his bicycle up the road. And so he checked me out and called an ambulance.
Nice.
A week later, the hospital didn't give me blood thinners. So my stent clogged up and I went into cardiac arrest. My son had to do CPR on me. And let me tell you, CPR really hurts. It's really painful because they have to break all your ribs and compress your heart. And then last August, I was riding my mountain bike again, and a tree fell out of nowhere and landed on me like a 70-foot tall tree, and it actually broke my neck and back. And so I had to wear a brace for 4 months. Luckily, I came out of that pretty good. My golf handicap has actually dropped 2 points since I broke my back. So
it finally put me in to take care of my hook.
yeah.
It put me in play. Okay, so all right, crew. What we learned by all this is Byron's not going anywhere. He will handle your taxes until the zombie apocalypse, and then he will probably lead. He will be the zombie apocalypse leader. Where are you guys out of?
We're in California, but we work all over the nation.
Got it. So well done. But see, that's what I want to know. That mad props to you. I don't want to hear it, Melanie. Mad props. That's death defying. That right there is death defying.
It must be inherited because I used to skydive when I was in college, and my very first solo dive by myself, I had a chute malfunction and my lines twisted. I didn't crash. Luckily, I was a good student. I remembered what I was taught, but and I got out of it. But that's
awesome. So you're adrenaline junkies and all we need to know is that you're going to be around to be able to help your crews get your stuff done. This is amazing. All right. Besides that one, Melanie, what tells us about you above and beyond one-stop tax strategies?
Well, what tells you about me? I like to be creative, so I like to write some music.
What you're doing in Africa?
Oh,
there we go.
We have a school over there that we're helping. And there's about 300 or 400 orphans that are, kids that.
Shut up. So, see, this is what I want to know. So we're going with our kids this summer. My husband, myself, and then my kids, my 2 6 and 8-year-old. We're going to take them to Africa and get to go over there. So that'll be a lot of fun. Brilliant. All right. So if you guys haven't fallen in love with them like I have, then whatever. Yeah, you're dismissed. The bottom line here is the reason why I love this part of the interview is because we're all doing the thing we're doing for one reason or another. Most of us, at least the owners, those of us you're a family business, right? You're doing it because it's your jam. You're invested in it. And I don't want somebody who's doing a job doing anything for me. I want somebody, when I get people money, it's like I'm getting them my own money. Or I'm showing up for them because it's my passion. And so I just wanted my crew to learn a little bit more about you. And what most people didn't hear, Byron, is the mountain biking and all the things that you're doing as a man of 42 or 43. All the things that you're doing that keep you alive and well and engaged. And Melanie, seriously, a school that you're hosting and sponsoring and building to serve others, it just lets us know that you are forces both inside your profession as well as in the world. So thank you for joining me today. Where can we'll have them in the show notes, guys, but where can my people get a hold of you? How do we get our consultations? How do we do the things that we do? Yeah, so I do a lot on Instagram, and I do it on my own personal, on Melanie Sikma, or if they want to follow us at One Stop Tax Strategist, I tie them together so you'll see the same thing. Unless you want to see my personal weirdness, you can go on mine. That's half the fun here. That's half the fun, yeah. So do you do TikToks? Do we get to watch you dance? I'm off and on TikToks. I'm not always there, so
So not always there. It's not as consistent there.
Okay,
I
so
did
one stop tax strategist or Melanie Sikma on Instagram.
Yeah.
Very
Yeah.
good.
And then we talked about my dad twerking his way to taxes on one of our tax courses. So
Nice. And
then if they want to go ahead.
No, please finish.
I was going to say, if they want to text Get Fundable to 209-924-4192, we can give them white papers to the Augusta strategy and kids payroll, and just kind of walk them through how to do that if they want to take advantage of that.
You guys, there's some free goodies for you. What I call Scooby snacks, that you guys will be able to see how badass they are, and the giveaways that you can do. So text Get Fundable to
209-924-4192.
Okay, excellent. Oh, and by the way, a little known fact, when Melanie and I first met at the event, we were talking where we came from, and I graduated from Modesto at Fred C. Beyer High School, Ripon, which is where Melanie currently resides. Byron as well, right?
Yeah.
You guys are in Ripon, which is 11 miles maybe north of. I mean, we're super close. So they were all the same football competitive areas and stuff like that. She was in a couple of years younger than me, going to school, but Byron and I were probably peers. So, so I just love Central Valley, go San Joaquin Valley. But thank you for coming and joining me on the Fundability podcast. It's been a delight. You guys are so much fun, and you're like big time pros. I've learned so much of what is capable and what's possible. So everyone, get on their calendars. Do you have a calendar, like findmelanie.com, and then
you guys can you can put it in the show notes. It could be in the show notes. I put a calendar link. They can book a call there, and we'll just do a free tax assessment. It takes about 20 to 30 minutes, and by the end of the call, you'll know if you're paying too much in taxes.
Brilliant. Guys, rarely do I say you're an idiot if you don't. This one I'm saying you're an idiot if you don't. They have so many things, because you don't know if it's going to be baby mama strategy, grandmammy, or the mistress plan. Make sure you get something to start saving more money on your taxes than you think is possible. It's been my delight having you here, you guys. Thank you, Melanie. Thank you, Byron. It's a pleasure. All right, tribe. I'm telling you, let's do this thing. We are
money for nothing and your dreams tax free, we say.
Money for nothing and tax dreams free. I love it. Be well. And you guys have a blessed morning, evening, or afternoon, whether you're on a treadmill, a bicycle, ready to have a tree fall on you like Byron. Whatever you're doing while you listen to this, do something now. Do it now, because tomorrow will be too late, because I'll be coming at you with something new. This is Merrill Chandler, your guest, your host of the Fundability Universe. Peace.
Thank you for listening to the Get Fundable podcast. Please leave comments, because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast, because we want them to get fundable too.